Right, good afternoon, YouTube. Thanks for joining us. It is Tuesday, the 15th of August, smack bang in the middle of the quietest month of the year. So, what have we got for you today? Well, quite a busy one in terms of data today. Even overnight, the Aussie wages was a little bit softer. Industrial production in China. Well, is it a surprise that things are really slowing down over there? Probably not at the moment. Retail sales struggling as well over there. But it was the FTSE's had a hell of a day today, and it's all due to not the claimant count change, which was a little bit higher. Kind of bad news for the pound you would have expected, but this was kind of out, undone a little bit by the revisions that we had. So this was 10,000 worse than expected, but the revisions were basically 10,000 better than forecast. So there wasn't a net huge difference on the claimant count, but the average earnings index was up significantly on this today. Expecting a 7.3 print, got an 8.2. So wages are really accelerating higher here. And even the revisions to the previous month were up notably as well, from 6.9% to 7.2%. This typically would be good for the pound, which it kind of was early on, but not to a huge degree. If you look at what happened with cable on the figure, and we did get that initial move higher, it gave most of it back, but it has been kind of grinding slowly higher throughout the day. But as I say, the real action was in the FTSE. Not initially. I know Neil was on this morning with a few of the guys in here. In the FTSE go pretty much nowhere at 7 o'clock. So this was the 7 o'clock figure. We kind of gapped into high volume area up here actually. That ended up ended up seeing it start to drift. It took 15. We were down from where we were at the figure. More than 2 ticks away. It took until about 7:30, and we started to see that weakness in the FTSE come through. And then by the time the market opened at 8 o'clock, it was curtains, sold off, retested, and there wasn't too much in the way of strength in this market. This is not a small move by any stretch, especially at this time of year. If you look at where we opened to the lows here, you're looking at 121 ticks, 1.6% downside for the day to the lows on the FTSE 100 today. So this was a trade that I know a few caught. So very well done to you if you did, because this should have been an easy one to make a few quid out of. What else came after that? We had not a huge amount of surprise on the ZEW numbers. It was basically in line with forecast in Germany. Slightly bigger beat in the broader Euro area, but still negative. We've been pretty negative for a while now. So the last time we had a positive print was back in April, and they are looking pretty ugly, but not as bad as they were kind of this time last year when we had some very, very horrible prints on the ZEW numbers. Since then, this afternoon, we've had more higher inflation, because obviously this retail average earnings is an inflationary pressure, right? Wages are a big component of inflation and what makes inflation sticky, because wages tend to only go up and not go down. But the CPI figures in Canada kind of echo this, right? We had a 0.3% read, a 0.6% hit on this one. So expecting the 0.3, the sort of beats and misses we've had kind of 0.2s here. Generally, it misses by 0.1s. Last time we had a 0.2 miss was back in Feb. So yeah, you're talking 6 months ago was the last time we had a beat or miss about this big. So a little bit of surprise, to say the least, on the dollar, on the Canadian dollar. There was data out for the US. I'll look at this in the context of yen, and that's what created this decent spike in the CAD yen, seeing 30 ticks or so. Has given some of it back, but we're still much higher than where we were when that news broke. And this came at the same time as some mixed data from the US. Quite a lot of data today to summarize with you. Core retail sales out, along with retail sales, both beating expectations. We had a 1 print on the retail sales, a 0.7 beat on the core retail sales, a 0.7 beat on the headline retail sales. But this was undone a little bit by the Empire State Manufacturing Index actually being worse than forecast. So this is a little bit of kind of shady, conflicting data. And you can kind of see why we don't like trading these. Let's take a look at, say, the dollar against the yen. This initial action was dollar strength. But since giving it back, and this is why I would not, if I'm trading data, which to be fair, I'm not doing this month particularly. If I was, I would be looking for data that both supportive, both unsupportive for your move. Whereas on this one, we had some positive news and some negative news. If you went long, you stopped out. If you went short, you might have been stopped out of here too. So I don't think this was a particularly good one. Hopefully, this is for those of you who were trading this. Maybe this is a good lesson to look at. If you have one piece of data pointing in one direction, one pointing in another, maybe leave it alone, especially in August. So what have we got the remainder of the day? Not much in terms of data coming out. We are kind of looking at quite an interesting week here anyway. There have been some big changes in the macro picture. I know we mentioned this morning, but the yields are very much in vogue. Today we had that spike. If you look at the this little spike higher on the yields, this was bang on the data at 130. We're initially pushing up, but then giving pretty much the day's gains back on the yield. So that has taken it somewhat away from that previous swing high, or we're just at that previous swing high from the 4th of August. Again, having nudged through it yesterday and moved through it a little bit more aggressively. This is very, very close to where we were at the highs of October. It's probably worth noting this yield high. Where are we? The previous high at 4.335. That was the high from 2022. This is the high for over a decade, right? If you want to go back in time on this, you can see how long ago it was. We were last at these sort of levels. You're going back to 2007 for yields to be significantly above where we are today. So what does this mean on a slightly shorter scale when we're looking at the stock markets? Well, if we overlay the S&P 500, a little bit of a picture. Let's not look at the recent events. Let's maybe look back to last year. When these yields were pushing higher, this is when the stock market tended to struggle last year, especially from August. That big turn that we had in the stock markets in August, it was telegraphed a little bit by the yields starting to push higher again. And it took a little bit of time. We had a lag on this when the low was there to the high in stocks, 10 or 14 trading day or 2 weeks effectively before the stocks turned. And now we're starting, you can see how that aggressive move up in the bonds ended up being the big kind of final washout in stocks. So what's the relationship looking like now? Well, now that we've had yields back to where they were at that point, and somehow miraculously we're up a best part of 800 ticks on the S&P compared to where we were then. But is this starting to be the time when things will change? And I feel if this trajectory continues, stocks can only move one way in the end. But whether you want to be short here is another question. Trading in August can be tricky. So if you want to kind of put on a big swing trade, perhaps maybe trade it with options might be a little bit smarter, as we were talking about this morning. And that leads me on to option expiry, right? We've got option expiry on Friday of this week. And these are often when you get tipping points in price. It's always the third Friday of the month. So if you go back to the third Friday in July, not much happened here. We didn't really get the rollover that I was hoping for or anticipating on that Friday. But if you look back to the June option expiry, the third Friday in June, that was after a nice rally, a nice little tipping point where the markets moved down to the downside. Same for May, the third Friday in May. We had a little pop. This was highs of the year at the time. And then we had a similar move. It doesn't look like much, but over the course of the Friday to the following Wednesday, you're looking at over 100 tick sell-off in the S&P, nearly, over 2.5%. So not sniff that. These are often the times when the market turns. But having said that, the market's been going down this month, so maybe the turn will be back to the upside. So it's conflicting. I feel like we're probably going to see new highs in September, in spite of the bad news that we've had in recent weeks. So that's a decent summary of what's been going on. We've got 30 seconds to the open. And let's see what the market has for us. We've kind of done the range on the Dow. Quite a big sell-off in stocks as we saw. If we get a chance, I might have a little look at the Home Depot earnings because they did push the Dow up, but it did not last long at all. So one of the few Dow trades that I've taken this earnings, which hasn't made money. Right, 3 seconds to the open. Let's see what we've got here. Take a look at the Dow and the Home Depot currently. So this was the Home Depot earnings, or I say the time of the earnings when we had this pop at 11 o'clock. And in the pre-market, we have seen an appetite to the upside. So this may mean that the Dow might be a little bit of an outperformer relative to its counterparts, given how strong this is. This is the third biggest stock in the Dow Jones. So it would be a nice trade. You can do these with spreads where you're maybe long one Dow and short, 2.5 Nasdaq, or maybe 2 Nasdaq at the moment, given that the pricing. And yeah, if that was the case, yeah, the Nasdaq is flat to off a smidge, and you are seeing the Dow up on this today so far. Very early, we're not even a minute into trade, but these are the ways that you can kind of manage your trades and manage your risk a little bit with not having complete exposure to the market. Because the risk you've got with this is, Dow is starting to push on quite nicely after those Home Depot earnings, topping 49s, 30 ticks or so far, first minute or two. But we are in headwinds here, right? This is a big sell-off that we've had to the lows. So from 8 o'clock, when the European markets open, the Dow was down the best part of 300 ticks, right to the bottom of this little area. What is this area that I've highlighted in here? If you take a look at the volume profiles, this will be an area of congestion. Here we go. So this is where it's not a science to this, but this is kind of the area where we've seen a lot of trade down here. But we're obviously in this one up here, where we've seen a significant amount of trade, and markets get really sticky in these areas. Talking about sticky inflation, well, markets and pricing can get sticky in places where it's traded a lot before. And yeah, the bottom of this range is basically where we got to today, the low for the day. And if it cracks through here, there's very little liquidity in here. So I'd be expecting, if that low from today goes, you could easily see a dip down to this price here. Where are we? How much lower is that? You're looking at another 300 plus tick pretty quickly, maybe over the next day or two, if that level does break. So something to bear in mind with price on the Dow at the moment, because it is currently holding on. As I say, there are some tailwinds for the Dow given the Home Depot earnings, but having literally got down to the very bottom of that range today and found support, maybe it's just going to trade back in this range. And as we've seen a lot this week, the grand old Duke of York markets, as Neil's been calling them, markets go down, but then they go straight back up again. And when they go up, guess what? They turn around and go straight back again. We've seen that a hell of a lot for the last couple of weeks. Something you would probably expect in the summer more than at any other time. So yeah, bear that in mind for the day. Lots of motivation to trade, but I'm definitely keeping my powders dry, drier than usual this time of the year. You know, August is a pretty bad month for trading, typically in terms of real follow through in price. That's why we're seeing these big moves up and then it all being given back. But if you have, a strategy you want to run and having some success with them, I'd still recommend just being that little bit extra cautious at this time of year. I find that if I trade the same way as I do in August as I do in the first half of the year, or from kind of September to December, I don't do as well as I do in those other months. So, trade smart if you can. Try not to be overcooking it. We do have more earnings later in the week. That's where my focus will now look to on the Walmart on Thursday. I mentioned the earnings we talk about for Home Depot. Yeah, this share is pushing those highs that we had pre-open. But if you look back to when this is a 5-minute chart. If I can go back to the 1-minute chart on this, when those earnings did come through, you can see the volume spike at 11. We did have a 45 tick rally out of Home Depot, 47 ticks, but it was short-lived, and after 3 or 4 minutes, the selling that we'd seen in other asset classes, other stock markets, started to roll into the Dow, and it was quickly within another 3 minutes back to where it came from, and then, as we saw, roll down towards the low of that range, finding some support. So yeah, not the best earnings today on Home Depot. Hopefully better out of Walmart on Thursday. We do have inflation figures out of the UK in the morning, so 7 o'clock sharp. So if you do want to look at potentially trading some figures on that, the FTSE moved another 100 ticks on this news last time out. So yeah, bear that in mind for tomorrow at 7. But yeah, we'll be back with a Zoom at 7:50 in the morning.